Welcome to Stony Finance Lab channel.
Moving average convergence divergence, or better known as MACD, is one of the most popular indicators in technical analysis. Most technical indicators fall into one of 5 categories: trend, mean reversion, relative strength, volume, and momentum. MACD is most popular when discussing the momentum category. MACD analysis contains 3 main elements: the MACD line, signal line, and histogram. The MACD line represents the difference between short-term and long-term exponential moving averages, or EMAs. The signal line represents the 9-day EMA of the MACD line. The mathematical solutions behind these lines allow for crossovers between the lines, which ultimately generate signals to either buy or sell. The histogram, which is plotted alongside the MACD line and signal line, offers visualization and acts as a reinforcement of signals. The histogram is formed based on the disparity between the MACD and signal lines. Crossover of the MACD line above the signal line suggests that short-term momentum is becoming more bullish than the long-term trend. This implies a potential upward movement in the price. The bars in the histogram are positive when the MACD line is increasing faster than the signal line. These bars are often green in color, which is visually helpful during analysis. A positive histogram reinforces the strength of the bullish momentum. Crossover of the MACD line below the signal line implies that short-term momentum is turning more bearish than the long-term trend, suggesting a potential downward movement in the price. When the MACD line crosses below the signal line, it triggers a sell signal. This corresponds with a negative histogram formation. The bars in the histogram are negative and commonly red in color when the MACD line is decreasing faster than the signal line. A negative histogram confirms the strength of the bearish momentum.
Now that we know the components of MACD and the signals tied to it, we can dive a little deeper into how we can make this strategy a little more efficient. By combining the MACD with the use of other indicators like the moving average exponential, also known as the EMA, it offers traders a more enhanced and reliable trading strategy. Following a 12-26-9 with a 200-day moving average, this can create a little more precise reading. To avoid false signals, we can also implement price actions by adding key support and resistance such as trend lines, support levels, and volatility can offer us a more thorough and comprehensive analysis. Although, we must remember that shorter settings are more responsive but lead to more false signals, while longer settings are more stable but slower in response.
Let's look at a specific example of how to use our modified MACD strategy. We have chosen Bitcoin for our example, and our entry point of the trade is when, as you can see on the left-hand side with the green arrow, the MACD line is crossing the signal line and, important, the 200-day moving average on the top half of our picture has to be below the market value. We then exit our trade when the exact opposite happens, meaning the signal line crosses the MACD line, indicating a market downward movement. In our example, we can see a significant increase of market value within the period of our trade.
MACD is publicly available and does not require a substantial amount of time to learn or a lot of money to utilize. MACD is a perfect tool for college students to learn and get their feet wet for trading and investing. Because of its simplicity, MACD is most efficient when combined with other indicators. MACD is most successful during uptrends, so using a 200-day moving average exponential indicator will reinforce MACD's efficiency.
MACD's patterns and signals influence traders in various ways. Their connections align with psychological biases and concepts. Their understanding can help us make better decisions and influence market dynamics towards a more positive outcome. Let's dive into it. Traders often exhibit confirmation bias, a cognitive tendency to interpret information in a way that confirms their existing belief. MACD signals such as crossovers and divergence provide clear entry and exit points, shaping traders' biases. Furthermore, MACD, particularly its histogram component, reflect changes in momentum. In behavioral finance, investors are vulnerable to the fear of missing out and may chase momentum, entering or exiting positions based on the perceived strength of the trend. Last but not least, MACD is also a so-called trend-following indicator, helping traders identify the direction of the market trend. In behavioral finance, this aligns with the component of herding behavior, where investors tend to follow the crowd. Thank you for your time. I hope you learned a lot, and I'll see you next time.
Thank you for watching this video. Please feel free to like, comment, and subscribe to this YouTube channel.